So what's the best option for you? In an ideal world, don't take external funding. In an ideal world, if you can help it. But that's hard for most companies. You do, but if you take it, there's a big advantage in taking capital, the right amount of capital at the right time. And make sure you follow those two things, the right amount of capital and at the right time. There's a big advantage because you can't truly grow your business with that. But before you do that, before you go to approach these various sources of funding, really figure out what your goals are. What do you want to do as an entrepreneur? What do you want to do with your life? Do you want to swing for the fences, or do you want a lifestyle business? It's fine. There's nothing wrong taking one track or the other, but determine what you need, and then go out and approach the suitable funding source, the right funding source for that. And then again, like I said, remember, securing funding is just the beginning of the process. That's not the end. A lot of people make that mistake. This is just the beginning, because then the hard work begins of really converting those funds back into returns, attractive returns for investors. Thank you.
We're going to transition into the panel discussion, and so Jim Coonan is going to moderate the panel, and I'm going to turn the program over to him.
Well, actually, I'm going to let you gentlemen introduce yourselves, because we do have a good combination of folks. So why don't we start, Dino, say a little bit about yourself, and we'll just kind of work down the road here.
Yeah, so as Jim mentioned, I've got an early stage venture capital firm. We manage a $90 million fund. We're focused on early stage web, mobile, and software companies. So there's, and my background is primarily, before getting into venture capital, I was in several startups myself, and mostly out of the mobile space. So that's, and then in terms of Bend, actually I just recently made an investment in Bend, so we can talk about that later.
Hi, I'm Jim Noonan, and just so you're not seeing cross, Jim Coonan and I have this traveling roadshow we've been doing for years. So, I'm the non-techie guy up here. I was a history major. I started a private equity firm in the Bay Area about 20 years ago that did turnarounds. So I kind of come at things from an operating and cash flow standpoint. More recently, since I've moved to Oregon, I've been involved with the Oregon Entrepreneurs Network, and I'm chairman of the investment committee there. And also do a number of what can only be described as sort of squirrely one-off cash flow types of deals individually and with small groups of people with whom I invest. And so we can talk about some of those kinds of things. They tend to be decidedly in non-techie businesses, so there is money for non-technology businesses as well.
I'm Art Heemstra, and I wanted to make sure you knew which one was the banker on the panel, so there you go. Put on the tie. I've been in banking and lending for a lot of years. Mostly in Oregon and Washington. Was with First Interstate Bank, which today would be known as Wells Fargo, for a number of years, and then in the 90s opened a Northwest division for Silicon Valley Bank, and was and it started that operation in the Northwest and grew it during a terrific time to be in that kind of a bank. It was a decade when money was just rolling into startups, and as a banker you just had to grab onto the train and hang on, and it was easy. Got the entrepreneurial bug by watching so many of my companies do great things, so that I left banking in 2003 and joined a privately financed finance company. And we raised money from a private equity firm and from a group of banks, and opened little offices around the country and made loans to startup and early stage companies. That was our swing for the fences, and we missed. When the current recession hit, our funding sources dried up, and we decided to wind that company down, and I joined a bank that happens to be headquartered here in Bend, the Bank of the Cascades, although I work in Portland. But if you look around, you might see some other people with ties on. They're probably bankers. That's the signal. Or lawyers.
Or blue jackets. I think. My name is Jeff Onsbach. I'm the CEO of Warm Springs Ventures, which is essentially the economic development corporation of the Confederated Tribes of Warm Springs, about 60 miles up the road. My background, I guess, this started out in auditing with Deloitte Haskins and Sells back in the day, and I think I remember we had about 4 or 5 saving and loans customers back then, fighting off the Resolution Thrift Corporation, and I think that's probably where I started getting into the turnaround field. I spent about 9 years in the turnaround field before I came to Warm Springs. As part of that, I kind of went back and looked at my cases that I worked on. It was about 20 of them. 10 of them were Chapter 11. The other 10 were essentially businesses who hit a rough patch and were looking for their next round. And so where I really focused a lot of my energies was in the financial projection side. So kind of developing the business plan, and some great comments earlier in making sure you right size your ask and really know the business, know the financial projection piece of this. So through that we raised over $750 million in 9 years for businesses in bankruptcy or on the verge of bankruptcy, and hitting up venture capitalists as well as banks. I normally sat on the other side of the table from the banks, but I also worked on the creditor, the debtor side as well. So lots of experience there. Kind of moved into the tribes, and now I'm doing the same thing, constantly looking for funding. I'm always on, I'm always, it's a full-time job. It's 100% of the time you're always looking for funding. Maybe not asking for money, but always looking for funding. And in this instance, we're doing a lot of that with the tribes. Started up a telecommunications company there by using USDA funds, Economic Development Administration funds. We won a $5.8 million RO award. Cobble together some funds from other areas. So it's definitely kind of in that same vein, I think, is what the conversation is going on here.
Okay, so let me start with Art. Kind of a basic problem with startup companies is you don't have collateral. Banks don't like air balls, as I was told when I went and pitched them. So can you talk a little bit about, is there a role for banks with these early stage companies?
So there's a natural relationship that starts off on day one, and the question is, how do you turn that into value for a company? Is there any value in having a banking relationship if you're not getting a loan? Because the fundamental thing, whether it was Silicon Valley Bank or this bank that I'm with now or before, is that banks really aren't the source of startup capital. We're not the first money into a deal, and I've never seen a bank that provides that very first money, because that is risky money. The first dollars that go in have a potential return if the business does well, and the people that are willing to take that risk should get a big return by way of being owners. So on day one, no, there's really not a role for banks to provide capital, but that doesn't mean that a company and a banker shouldn't get together and start a dialogue. One of the things that make good bankers over time in the banks that I've seen are bankers who are curious and like to ask questions and like to learn about the business. And so I would say that as a depositor in a bank, try to extract some value. Ask to meet with a banker. And if you can't find a banker in the bank that you're with that's willing to listen and begin to learn about your business and provide some connections and introductions and advice, then try another bank. Because there are bankers, not every banker is the same, but I think that's the initial value is a friendly and non-threatening and non-enforcing sounding board to try out ideas on, and to educate yourself and have the banker educate you as to when the debt switch might be, light up when the switch is turned. Because there will come a time, and it's not the same at all banks, but there will come a time when capital can be available, and I can get into that later. But
so the old model, if you will, was venture capital. Put money in, and you run through. How much money did you guys go through? 19 million, and sort of like the Harry Potter movie, right? You just believe if you push that cart, you're going to go right through that brick wall, right? And then there'll be another world on the other side. So that was the old model, and we know that VCs made a fair amount of money because they had these huge funds, and they get a percentage of those funds. And the companies loved it because they got a whole chunk of change. And you had an IPO. Well, you know, it feels like it's a different world out there now. I mean, you mentioned, Kanth, that, you know, there's one IPO or maybe very few IPOs, but is that really the exit for a lot of these companies now?
You know, structurally, it's become much less expensive to get a company started. So because of the cloud, because of open source software, because of a lot of those factors, it's become really inexpensive and much easier to start a company. So what used to take, you know, 10 years ago, maybe $3 or $4 million to get launched, you can now get launched on $100,000 or $200,000. So I think that has brought angel investors into the equation. So that's, you know, that plus sort of some of the Web 2.0, you know, phenomenon and really the explosion of mobile and mobile apps, it is really sort of what has brought out a ton of these angel investors, and that has sort of taken over the really early stage investing landscape. I think venture firms have moved a little bit later, especially the larger ones, you know, because they have to deploy larger amounts of capital. And I think that the return profile that's required for an angel investor is maybe a little bit different than a venture fund. You know, I think a lot of angels would be happy with a 3 to 5x return. You know, a venture fund, you know, needs to swing for the fences on most of their deals if they're going to, you know, have one that sort of, you know, results in a huge outcome that returns the fund. So I think that has, you know, that dynamic is still there, but you know, the IPO market has been pretty dry, except for the last maybe year or so. I mean, but really, I mean, the last 10 years, except for a few businesses that just became, you know, hugely profitable, like Google and, you know, the latest round here. I mean, you know, everybody's waiting for the Facebook IPO, but you know, apart from that, it hasn't been like a robust IPO market. So most of the exits have been in M&A, which is why the whole model now with angel funded you know, deals, it works because if the M&A market is willing to pay $30 to $50 to $100 million, you know, that doesn't really work too well if it took $40 million of invested capital to build that business, you know, so that you're not really generating a good return. But if it only took 1 or 2 or 5 million, you know, now you're generating a reasonable return for those investors and for the entrepreneurs.
Yeah. And Jeff, I know you're now in that same realm and you've also played in any different perspective or thoughts on that?
Yeah, my perspective is that what I've kind of seen after the bubble burst is, you know, prior to the burst, everyone was just fixated on 30% returns, and it seemed like, and it's been 30% for quite a long while, and then after it burst, I don't see a lot of people getting excited about anything below 30%. The risk is a little bit higher, but they're still kind of fixated there, and I do think there's a little bit of a paradigm shift in what we can expect for startups or for businesses that you're generating. So a lot of times the VC guys or certainly not the banks or the angels are a possibility, but you really have to reinvent your search for capital and be completely agnostic into the source of it. You know, we mentioned a small business administration loan guarantees to compel banks, to give banks a reason to come to the table to even listen. But there's a lot of grants out there. There's a lot of other things that if you can pass muster on some of these other sources of funds, you're going to start attracting more bears to the honey. And that's what you really need to try and focus on is if you can't reach that 30% return market and you don't have a lot of collateral to give up, there's still a lot of other options out there to go pursue. And to me, that's a lot different than it was 5 years ago.